Bismillahirrahmanirrahim. This is the third video on proof, property, cost, disposition under successful efforts method. In this video, we will talk about cost disposition through abandonment or retirement of proof property and impairment and solve exercises comprehensively. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is a K. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We also hope that this video helps fresh graduates who have joined the oil and gas companies and want to refresh their learning on cost disposition through abandonment or retirement of proof property and impairment. So let us start with the cost disposition through abandonment or retirement of proved property. No gains or losses are recognized if an individual well or an individual item of equipment or a single lease of a group of properties of proved properties are abandoned until the last well ceases to produce and the entire amortization base is abandoned. Till that time, any well or item of equipment or lease that is abandoned is a part of an amortization base and should be treated as fully amortized and charged to accumulated DD and A. If the abandonment or retirement results from a catastrophic event, then the loss should be recognized. Let us solve an illustration in this regard. Lucky Oil Company abandons a well with total capitalized cost of 500,000. The well is located on a lease with 10 other producing wells. Total accumulated DD&A for wells and related equipment and facilities on this lease was 1,500,000. No equipment was salvaged. So you can see that the well is amortized as a part of a larger group of equipment. So the accumulated depreciation related to this individual well is not determinable. So the cost of the well net of any salvage value will be charged against accumulated DD and A. And the journal entry will be accumulated DD and A debit by 500,000 and wells and related equipment and facilities credit by 500,000. However, the entry will be different if the well is the last one in the amortization base and the entire amortization base were being abandoned. So let us look into an example in this regard. Lucky Oil Company abandons a lease with capitalized acquisition cost of 70,000 and capitalized drilling and equipment cost of 200,000. Equipment worth 30,000 was salvaged. The lease was part of a field that has total accumulated DD&A for proved property of 300,000 and total accumulated DD&A for wells and related equipment of 500,000. This lease was not the last producing lease in the in the field. So now you can see that this lease is a part of a larger group of properties. So the accumulated depreciation related to this lease is not determinable, and the entire cost of the lease net of any salvage value, that is 30,000, is going to be charged against the DD&A. So material and supplies salvage value will be debited by 30,000. Then accumulated DD&A for the proved property is going to be 70,000, and accumulated DD&A for the wells will be net of the salvage value, that is 200 minus 30,000, that gives us 170,000. Proof property will be credited by 70,000, and wells and related equipment and facilities is 200,000. Now this was the situation because the lease was not the last producing lease in the field. Okay. Let us go to the second situation. The lease was the last producing lease. Now this is the last producing lease in the field. All other properties have already been abandoned. All the properties have been abandoned. The balance in accumulated DD&A for proved property was 65,000. So accumulated DD&A for the proved property is 65,000. The salvage value was 30,000, that is already there. And then we have add accumulated DD&A for wells and related equipment and facilities is 155,000. Then the proved property is 70,000, and wells and related equipment and facilities is 200,000, 270. So the balance between the two is 20,000, and this will be recorded as surrendered lease expense. So you can see that in case if it is a last well in the field or cost center and it is plugged and the lease is abandoned, then all of the remaining asset accounts and the accumulated DD&A accounts are written off and a gain or loss is recognized now. Next, let us look into what happens in the case of sale. Now, Lucky Company sold a pump costing 2,000 for 200 salvage value. Now, sale of some part of a proof property is treated as a normal retirement with no gain or loss recognized until non-recognition of such gain or loss does not have a material effect on the unit of production amortization rate for the cost center. If there will be a material change or distortion in the amortization rate, then the gain or loss should be recognized. So the journal entry will be we are selling for 200, so cash is going to be debit by 200. We are selling the equipment, so equipment is credit by 2,000, and accumulated depreciation DD&A equipment will be debit by the balancing figure, that is 1,800. Next, let us solve a comprehensive example. Now, on February 2, 2005, Lucky Company acquired a lease burdened with a 1/6 royalty for 100,000. The property was undeveloped and the acquisition costs were considered to be individually significant. So first of all, we are acquiring. So this is a right now, this is undeveloped. So this is unproved property, debit by 100,000, and cash is credit by 100,000. Then we go to number B. On February 2, a delay rental of 3,000 was paid. So delay rental expense of 3,000 is paid and cash is credited by 3,000. Number C, several dry holes were drilled on surrounding leases during 2006. As a result, on December 31st, 2006, Lucky Company decided the lease was 40% impaired. So this is an impairment expense, and 40% of 100,000 will be 40,000. So impairment expense is debit and allowance for impairment is credit. During 2007, Lucky Company drilled a dry hole at a cost of 350,000 for intangible drilling cost. So intangible drilling cost is 350,000, and 35,000 for the equipment. Okay. So the total cash we are paying is 350 plus this will be 385,000. The equipment, this is now since this is a dry hole, so we have to record the dry hole as well. So dry hole expense for the intangible drilling cost will be 350,000, and dry hole for lease and well equipment will be debit by 35,000. You see, it is a dry hole expense, and obviously well in progress are going to be closed. So well in progress are credited by 350,000, and lease and equipment is credited by 35,000. So that is how we record for part D if there is a dry hole. And next we go further. Undiscouraged, Lucky Company drilled another exploratory well in February at a cost of 500,000 for intangible drilling cost and 175,000 for the equipment. The well found proved reserve. So first of all, we are going to record the cost that they have incurred. They have incurred the cost on lease and well equipment, and still you can see this is a exploratory well. So well in progress, lease and well equipment is debit by 175,000, and intangible drilling cost, well in progress intangible drilling cost is debit by 500,000, and obviously they are paying cash, that is 675,000. Now they have found proved reserves at this stage. So the wells and progress are going to be transferred to wells and related equipment and facilities. So wells intangible drilling cost is going to be credit by 500,000, and lease and well equipment is going to be credited by 175,000. And then wells and related, this will be transferred to wells and related equipment and facilities intangible drilling cost for 500,000, and this will be 175,000. Now because they have found proved reserves, we have to reclassify the unproved property into a proof property, and don't forget that there was an allowance for the impairment as well. So we have unproved property is going to be credited by 100,000, allowance is going to be debit by 40,000, and the remaining balance becomes our proof property of 60,000. Then a total of 12,000 barrels of oil were produced from the successful wells during 2007. Related lifting cost was 4 per barrel. Lifting cost, which are production cost, should be expensed as lease operating expense. Note that production costs are based on total production from the lease, whereas revenue and the calculations of DD and A expense for Lucky would be based only on the working interest share of production. So the lease operating expense will be 12,000 times 4, that is 48,000. Then during December, Lucky Company began drilling the third exploratory well. Accumulated cost by December 31st were intangible drilling cost of 100,000 and equipment is 15,000, so cash is 115,000. Okay. The reserve report as of December 31, 2007 and production during 2007 were as follows. We have proved reserve, proved developed reserves. That means we have to calculate first of all that DD and A. And DD and A are going to be first of all for the acquisition cost, and the acquisition cost will be the proved property, that is 60,000 divided by the proved reserves, and the proved reserves are 900,000, and you can see that this is at the end of the year, so we will be adding the production as well, plus 10,000 times the production, that is 10,000, and this will give us 659. At the same time, we will also calculate the DD and A for wells and related equipment and facilities. Now you can see that the book value at the year end for the intangible drilling cost and equipment was 175 plus 500, that is 675, divided by proved developed reserves, that is 300,000. Again, this is at the end of the year, so we will add the production and then we will multiply by production. So the DD and A for equipment and facilities is going to be 21,774. So the journal entry will be DD and A. Don't forget that we don't use the word depreciation. We say DD and A, depreciation, depletion and amortization expense for the proved property was 659, and for wells and equipment 659 and 21,774. And obviously this will be accumulated depreciation will be credited by 659 and 21,774 for equipment and facilities. Let us continue with this illustration. During 2008, Lucky Company completed the third well. They have completed the third well at an additional cost of 300,000 for intangible drilling cost and 175,000 for equipment. The well was successful. So the entry to record the additional cost will be well wells in progress intangible drilling cost debit by 300,000, and lease and well equipment debit by 175,000, and cash will be credit by 475,000. Then we are going to now the well was successful, and when the well is successful, then the wells in progress for intangible cost, drilling cost, and lease and well equipment will be reclassified as wells and related equipment and facilities, and so this is going to be debit. Now before we do that, we have to look into the balances for well in progress for intangible drilling cost. So let me make a T account for intangible drilling cost as well as lease and well equipment. We are going to look into the wells in progress. We have to close them, so you can see that we have 35,000 for lease and well equipment, and intangible was 350,000. Then what else? Okay, now we have wells in progress intangible credit by 350 and lease and well equipment credit by 35. So this is 350,000 and 35,000. Then we go to the next transaction, number E. For E, again you can see we have a debit of for lease and well equipment debit for 175,000, and intangible drilling cost is debit by 500,000. 175 and 500. Then we have wells in progress credit now by 500 and 175. So this will be credit by 500,000 and 175,000. Let us see if there is any further well. Oh yes, there is. In number G we have wells in progress for 100,000 and for 15,000. So we have 100,000 and 15,000. Anything else? Okay, and then we have wells in progress over here for 300. How much? 300,000 for intangible drilling cost and 175 for lease and well equipment. So if we make the total, the balance for intangible drilling cost will be the debit 400,000 and this will be 190,000. So wells in progress intangible drilling cost is going to be credit by 400,000 and lease and well equipment, this is well in progress, and this will be 190,000. And then obviously they are going to be transferred to wells and related equipment and facilities. For intangible drilling cost it is 400,000. For lease and well equipment it is 190,000. Okay. Then during During 2008, a total of 36,000 barrels of oil were produced. Related lifting cost was 5 per barrel. Expense lifting cost. So we are going to expense lifting operating expense. This is an operating expense. 5 times 36,000 will be 180,000. Okay. Next is the reserve report as of December 31st, 2008 and production during the year for Lucky Company were as follows. We have proved reserves and we have proved developed. And so first of all, we are going to go again for the DD&A, and first of all for the acquisition. And for the acquisition cost, how much is the acquisition? Acquisition cost, okay, here acquisition cost is 60,000, and now we have to reduce the DD&A. The DD&A for proof property was 659. 60,000 minus 659 divided by proved reserves, that is 1,470,000. And since this is at the end of the year, we are going to add the production of 30,000 times 30,000, the production. This is equal to 1,187. Next, we are going to calculate the DD&A for wells and related equipment and facilities. So for this we have, how much do we have? Okay, so we have a total for intangible drilling cost, lease and equipment, that will be 675. And again, what else we have? And then we have made some more. Oh yes, here you see wells and related are there, 40,000 and 190,000, that makes 590,000 divided by the proved developed reserve, and the proved developed reserves is 970,000 plus the production, because this is at the end of the year, times 30,000. And don't forget to subtract the DD&A, that is 21,774 minus 21,774, and this will be equal to 37,297. Once again, we are going to record the DD&A, and for proof property it is 1187, and for DD&A expense for wells and equipment is 372,97, 37,297, and accumulated 1187, 37,297. Then number L, oh, that is interesting. A disaster struck and the company abandoned the lease. Okay, now when they are abandoning the lease, it means we are going to credit the proof property, and the proof property is for 60,000. We have already seen in over here, proof property was 60,000. It is credit. Then we will look for wells and related equipment and facilities and intangible drilling cost, and I would like to show you more. I will erase this one. So we have the intangible drilling cost, and let us see how we calculate. Now for intangible drilling cost, we have wells and related, not wells in progress, wells and related equipment and facilities for 500,000, and for lease and well equipment it is 175,000. 500,000 for intangible and 175 for lease and well equipment. What else? Oh yes, here. And then you can see we have wells and related equipment intangible drilling cost 400,000, and for lease, so first of all 400,000, and lease and well equipment is 190,000. So the total is 900,000, and this will be 365,000. Okay, so the wells and related, we are abandoning, so is going to be credited by 900,000, and lease and well equipment is going to be credited by 365,000. Then we will look into the accumulated depreciation for, first of all, the proof property. For proof property we have 659 plus 1187, that will give us 1846. And for wells it is 21,774 plus 37,297, and that is going to give us 59,071, and the balancing figure is going to be allocated to the surrendered lease expense, that will be 1,264,083. Okay, so let us solve one more exercise on cost disposition through abandonment or retirement of proved property. The following are costs incurred on Erath lease. Acquisition cost is 100, well 1, well 2, well 3, there are 3 wells, and tank separator flow line cost are 1 million. Treat each of the following independently, so they have to be considered independently. A fourth well, an exploratory well, was drilled at a cost of 2,010,000 and was determined to be dry. So first of all, this is a dry hole expense. So dry hole expense is debited by 2,010,000, and well in progress is going to be credited by 2,010,000. Okay, we move on to number B. Give the entry to record abandonment of well 2. Okay, we are going to abandon well 2. Equipment costing 50,000 was salvage. So equipment inventory salvage is going to be debited by 50,000. Accumulated depreciation on well and equipment was 5 million. Okay, so the 5 million, so well number 2 is for 3 million over here, and the balancing figure will be allocated as accumulated DD and A, that is 2,950,000. Okay, we move on to number C now. Give the entry to record abandonment of the entire Ereth lease. Assume the lease constituted a separate amortization base with accumulated DAD and A on leasehold cost of 40,000 and accumulated DD and A on wells and equipment for 5 million. So accumulated depreciation DD and A for lease and well equipment is 5 million. And then accumulated depreciation for proof property is 40,000. The proof property is acquisition cost, that is 100,000. And for wells and equipment they are saying the entire means well 1, well 2 and well 3. So if we make the total of these three, this will be 9 million. And the balancing figure will be the surrendered lease expense 4,060,000. Next we go to number D. Give the entry to record abandonment of the entire Ereth lease, assuming instead that amortization has been computed on a field-wide basis with accumulated DD&A on leasehold cost of 300,000 and accumulated DD&A on wells and equipment for 18 million. So this is for the entire, and you can remember that we have the proof property of 100,000 and wells and equipment is 9 million, and accumulated depreciation for the proof property will be 100,000, and for accumulated depreciation for wells and equipment will be 9 million. Okay. Let us solve another exercise. Now, Pine Oil Company began operation during 2019 and we have the following cost, and this is we have the three leases over here, A, B and C. A is completed, B is discovered to be dry, and this is not completed. And you can see that the stars over here that we may combine the entries for the different leases if it required. And they say require from the data prepare entries and prepare an income statement. So first of all we will go for the entries, and the acquisition cost of underdeveloped leases was 60, 30 and 40, that makes 130,000. Then number B, we have G and G cost expenses and we can combine, so 60 and plus 50, and this will be 200,000. Okay. Then we have number C. We have the drilling cost, and obviously these are at the time of acquisition, so these are wells in progress, and the cost will be 200 plus 230 plus 250, that will be 680,000. Then we go to number D. These are the drilling results. The drilling was completed, and because it was completed, it means the well in progress are going to be transferred to wells and equipment, and you can see it was for 200,000. And because this is completed, so the unproved property will be reclassified as a proved property, and that is going to be 60,000. So this is about lease A, and let us see what happens in lease B. For lease B, this is a dry hole, so we have dry hole expense, and drilling cost was 230,000. And because this is a dry hole, obviously there is no reclassification of unproved property to a proved property. And for lease E, we are not going to make any general entry because drilling is not completed. We go to number E. There is a production, obviously we don't record, we will be doing it in a while. Let us go on the next slide, and then we go to transaction number F. There is a lifting cost, and remember this is an operating expense. It is debit by 250,000 and cash is credit by 250,000. Then on December 31st, recorded DD&A, and there is an impairment for 60,000. So first of all we go for lease A because this is the completed one. So for lease A, we have first of all the leasehold cost, and that was, if you can remember, acquisition. So first of all, let us have the DD&A for lease A, and that is for the acquisition cost of 60,000. And the proved reserves are 700,000, and this is at the end of the year. So because this is at the end of the year, we are going to add the production, and the production is 10,000 times 10,000. So this will be equal to 845. So we have the leasehold DD&A expense of 845, and accumulated DD&A will be 845. That is for transaction number G first of all, and that is about the this was about the leasehold, and we are going to go for the DD&A for the equipment as well. Now for the wells, the equipment cost was 200,000 divided by the proved developed reserves of 300,000, and because this is at the end of the year, we add the production times the production, that is 10,000 barrels. This is equal to 6,452. So the DD&A expense in the case of equipment is going to be 6,452, and this is credit, not debit. 6,452. Now for lease B, it was complete and it was dry, and when it is dry, so there has to be an impairment, and impairment will be 40% of 40% impairment on 30,000. So this is going to be 12,000, and allowance is going to be credited by 12,000. There will be no entry for impairment because it is incomplete as far as lease C is concerned. And so we have A, B, C, D, E, F, G, and we will go for H on the next slide. For assume on January 2 of the second year 2020 that disaster struck both lease A and B. Give the entries to record abandonment of lease A and B. Assume equipment costing 15,000 was salvaged. Assume this is not a post-balance sheet event that would give a rise to changes in the balance sheet or income statement of previous year. So first of all, there is a salvage of 15,000. Then if you can remember the proved property, first of all this is going to be for lease A, and for lease A the proved property was 60,000, and for the wells and equipment it was 200,000. Then the accumulated depreciation that we have calculated before was 845 for the proof property, and for lease and well equipment it is 6,452. So this is 845 and 6,452, and the balance will be the surrendered lease expense of 237,703. Next we go for the lease B. Lease B was dry, and there will be an allowance again. If you can remember, it was 12,000. Allowance was 12,000. So allowance is going to be debit now by 12,000, and there is an unproved property of 30,000, and the balance is going to be allocated to surrendered lease expense, and this is going to be 18,000. So we have completed the entries, that is part 1, and we go to part 2, prepare an income statement. So assuming revenue to the company from oil sale is 1,200,000. So this is the revenue, 1,200,000. And then we will look into the G&G expense, and the G&G expense is 90 plus 50 plus 60, that is equal to 200,000. Then there is a dry hole expense, and the dry hole expense is going to be for lease B, because this is the one that is dry, and that is going to be 230,000. Then there was a lifting cost of 250. Then we have the DD and A expense, and there are two expenses in this regard, that is 845, 845 and 6,452, that comes to 7,297. Then there was an impairment expense, if you can remember, of 12,000, and the total expenses will be 699,297, and the net income will be 500,703. Let us solve another exercise on cost disposition. Rather we are going to talk about, we are going to start now talking about the impairment. And here, let us talk, this is an exercise we are talking about. So the following costs related to Good Luck lease as of 31st December 2020 is given to us. During early January, well number 2 quit producing and was abandoned. In March 2021, well number 1 quit producing and the well and the lease were abandoned. So we have for 2021, that is on January, we having a entry on January 2021. We have accumulated depreciation on, for this was well number 2. So this is for 420,000 accumulated depreciation debit and wells and equipment credit by 420,000, and you can see that it is not the entire lease that is being abandoned at this time. So we go for March 2021 and you can see that now we have both are going to be abandoned, and quit producing and the well and the lease was abandoned. So we have accumulated depreciation for proof property for 30,000. So we have accumulated depreciation for proof property 30,000. And then we have for the lease and well equipment, don't forget that will be the balancing figure. You can see that the total amount is 500 and we have already debited accumulated depreciation by 420. So the balance is 80,000, and then the proved property was 100,000 and wells and equipment was for well number 1 is 350,000 and the balancing figure is going to be 340,000. Now finally we are going to talk about successful efforts impairment. And assets should be tested regularly to prevent overstatement on the balance sheet. Impairment is a permanent reduction in the value of an asset. It may be a fixed asset or an intangible asset. It exists when an asset's fair value is less than its carrying value on the balance sheet. The company periodically compares the current book value with the total profit, cash flow, or other benefits that can be generated by the asset. If the book value of the asset is more than the future cash flows or other benefits of the asset, then the value of the asset is decreased in the balance sheet by the difference. Impairment results because of some unusual events like legal or economic conditions, a change in consumer demand, or any damage that impacts an asset. An impairment loss records an expense in the current period that appears on the income statement and simultaneously reduces the value of the impaired asset on the balance sheet. So let us look into an exercise in this regard. Lucky Company owns 3 oil and gas fields located in Texas and Oklahoma. Late in 2010, oil and gas prices throughout the world decreased by 30%. Lucky Company's manager do not expect prices to recover significantly anytime in the near future. Data for Lucky Field are given as follows. We have the net capitalization cost, expected undiscounted future net cash flow. We have fair value discounted future net cash flow. So they are asking, has impairment being triggered? So first of all, we are going to look into the expected undiscounted future cash flows, and what is interesting over here is we are going to go for field A. First of all, for field A, the expected undiscounted future cash flow is 600,000 and the net capitalized cost is 500,000. For B, it is 130 and 200, and for C it is 700 and 800. So the difference is 100,000. This will be negative 70,000, and this will be negative 100,000. So obviously there is no impairment for field A, but for field B, let us see how we are going to record it. So for field B, we have the future value discounted net assets, and that is 95,000. Net capitalized cost is 200,000. For field C, we have 520,000, and we have 800,000. So this is negative 105,000. This is negative 280,000. So what we do is we basically screen impairment for all the three events, because an event occurred indicates assets on all the fields that may be impaired. So to determine if impairment has been triggered, the carrying value of the assets is compared to the associated undiscounted future net cash flow, and the journal entry is going to be loss on producing properties is debit, and this is debit by 10. Okay, so there is no journal entry is required over here. It is only the impairment. So the impairment, I'm sorry, we are not going to go for the journal in this exercise, and we are going to solve one more exercise on impairment. Oh, this is a comprehensive one. Okay. So the Taft Oil Company computed DD&A on a field-wide basis. Balance sheet data as of 31st December 2018 is given to us. Taft's West Texas field are as follows. So these are the information: unproved property, net of impairment. So and all the information is given here, and we are required to calculate DD&A. Now using barrels of oil equivalent. And why we are using oil equivalent? Because there is oil and there is gas, both of them are there. We have to calculate DD&A. So let us go for the first part. So first is the production, and for production we have the information over here. Oil is 100 and gas is 500,000. We have to convert the gas into barrels of oil equivalent. So oil remains the same, 100,000, and for gas this will be divided by 6, so 83,333. This will be 183,333. Okay, then for the proved reserves, we have 1,020,000 and 5 million. So barrels will remain the same, 1,020,000, and for gas again we will divide by 6, and this time it will be 833,333, and the total will be 1,853,333. Okay. Now for proved developed reserves, we have 900 and 4,700,000. Again 900 for oil, they remain the same. Gas we divide by 6, and this will be 783,333, and the total will be 1,683,333. Next, we are going to look for the leasehold DD&A, and for that we first calculate the cost to be amortized. So for this we have the proved properties, and that is net, and the amount is 400,000. And you can see that new proved properties were also discovered for 50,000. So the total is 450,000. So the leasehold for DD&A is going to be um, the the leasehold DD&A will be the cost to be amortized, that is 450,000. Leasehold DD&A for leasehold, this will be 1 million, 450,000, the cost to be amortized, divided by the proved reserves, that is 1,853,333. To this we are going to add the production, because this is at the end of the year, that is production is 183,333 times the production 183,333. So this will be equal to 40,507. Now we are going to look for the wells and equipment, and let us see how we do that. We have the intangible drilling cost of 300,000. Then we have the lease and well equipment 1,400,000, and the accumulated depreciation was 1,300,000. This will be subtracted. Then the new successful exploratory well was 400. Then development dry hole is 300. Then service well is 325, and the new tank is 125. So if you make a total, this is 4,250,000. So the DD&A for lease and well equipment will be 4,250,000 divided by the proved developed reserve. This is at the end of the year 1,683,333, and we will add the production of 183,333 multiplied by 183,333. So this will give us 417,410. Now next so that is how we calculate DD&A. We have calculated for lease, we have calculated for the leasehold, and we have calculated for the wells and equipment. We go to part B, calculate DD&A for 2019. Assume that part of the field approved property with gross acquisition cost of 30,000, gross equipment cost of 70,000, and gross intangible drilling cost, they are abundant. So first of all, we are going to have the proved properties gross, and you can see that the gross will be proof property 500,000 plus 50, that makes 550,000, and from this they have abandoned the property worth 30,000, so we will subtract 30,000, so that gives us 520,000. Then we look into the accumulated depreciation, and that is 100,000, but 30,000 of property has been abandoned. So we will subtract this abandonment and the remaining amount is 70,000. So the net cost will be 520 minus 70. So the net cost will be 450,000. So that is how we calculate the cost in this case. And this completes our discussion on cost disposition through abandonment or retirement of proved property and impairment. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment section below or by email, and inshallah I will reply you back. Thank you so much and happy learning.